Hey everyone, welcome back to my channel. Today we're diving deep into the world of investing to uncover the secrets of expert strategies that can potentially turn your savings into a goldmine. In this video, we're going to break down some popular and powerful investment options, weighing their pros and cons so you can make informed decisions and put your money to work for you. Let's kick things off with what's probably the most well-known investment vehicle out there. Stocks. Stocks have been a cornerstone of investment strategies for decades, and for good reason. When you buy a stock, you're essentially buying a tiny piece of ownership in a company. This means you have a stake in the company's future and its potential success. Think of it like owning a little slice of your favorite bakery or tech giant. You get to share in the profits and growth of the business. Now, the exciting part about stocks is their potential for high returns. Stocks have the ability to grow your wealth significantly over time. When a company performs well, its stock value goes up and your investment grows. Sometimes it can even skyrocket, making you some serious cash. This is what makes stocks so appealing to many investors. But here's the catch. With great potential for reward comes, you guessed it, high risk. The higher the potential return, the higher the risk involved. The stock market can be volatile, meaning prices can swing up and down like crazy, especially in the short term. This volatility can be nerve-wracking for some investors. Remember what happened in 2020 when the pandemic hit? The market took a nosedive, and many people saw their investments shrink overnight. It was a stark reminder of the risks involved. External factors, economic downturns, even a company's bad decisions can impact stock prices, making them unpredictable in the short term. It's important to stay informed and be prepared for these fluctuations. However, for those who are patient and have a long-term investment horizon, stocks can be a powerful wealth-building tool. Patience and a long-term perspective can help you weather the storms. Over the long haul, the stock market has historically trended upwards, delivering solid returns for those who can stomach the volatility and ride out the dips. Historical data shows that the market tends to recover and grow over time. Think of it like a roller coaster. It might be scary at times, but if you hold on tight, you'll eventually reach the end and hopefully enjoy the ride. The ups and downs are part of the journey. If you're not up for the challenge of researching and picking individual stocks, don't worry. There are other options. You don't have to go it alone. You can always opt for mutual funds or ETFs, which we'll cover later. These options allow you to invest in a diversified portfolio without having to pick individual stocks. Another thing to remember is that investing in stocks is like anything else in life. Diversification is key. Don't put all your eggs in one basket, or in this case, in one stock. Diversification helps spread risk. Spread your investments across different companies, industries, and even countries to minimize your risk. A well-diversified portfolio can help protect you from significant losses. So, are stocks the right investment for you? Well, it depends on your risk tolerance, investment goals, and time horizon. Assessing these factors will help you make an informed decision. Alright, so we've covered the exciting, potentially high-return world of stocks. Now let's switch gears and talk about something a little more stable and predictable: bonds. Think of bonds as loans that you give to governments or companies. When you buy a bond, you're essentially lending them money, and in return, they promise to pay you back the principal amount plus interest over a set period. Unlike stocks, bonds are generally considered less risky because they offer more predictable returns. You know exactly how much interest you'll receive and when you'll receive it, making them an attractive option for investors seeking a steady stream of income. This fixed income can be especially appealing for retirees who rely on their investments for regular cash flow. Now, let's talk about the different types of bonds. First up, you have government bonds, considered one of the safest investments out there. These are issued by governments like the US Treasury bonds and are backed by the full faith and credit of the government. They generally offer lower returns but are considered extremely low risk. Then you have corporate bonds issued by companies looking to raise capital. These bonds typically offer higher interest rates than government bonds because they carry more risk. The risk here depends on the financial health of the company issuing the bond. So, bonds offer a level of stability and predictability that stocks don't. Let's dive into the world of real estate, a tangible and potentially lucrative investment that's been a cornerstone of wealth building for generations. Real estate has long been a favored asset class for those looking to diversify their investment portfolios. Unlike stocks or bonds, real estate represents a physical asset, a piece of land or a building that you own. This physicality provides a sense of security and stability that many investors find appealing. It's something you can see, touch, and even live in. This tangible nature of real estate makes it a unique and personal investment. One of the biggest draws of real estate is its potential for generating passive income through rental properties. This steady stream of income can provide financial stability and freedom. Imagine having tenants pay down your mortgage while you sit back and collect rent checks every month. Sounds pretty sweet, right? This can significantly boost your cash flow and help you achieve your financial goals faster. And as your property appreciates in value, you build equity and wealth over time. This appreciation can be a powerful wealth-building tool, especially in a strong real estate market. But hold on. Before you jump headfirst into the real estate game, it's important to understand both the amazing benefits and the potential challenges that come with it. Being well-informed can help you make smarter investment decisions. Real estate is not a get-rich-quick scheme. It requires patience, research, and a good understanding of the local market. Successful investors spend time studying market trends and property values. First and foremost, real estate is illiquid, meaning it's not as easy to convert to cash as stocks or bonds. This illiquidity can be a drawback if you need quick access to your funds. Selling a property takes time, effort, and often involves hefty fees and closing costs. These costs can eat into your profits and should be factored into your investment strategy. So if you're looking for an investment that you can quickly cash out, real estate might not be the best option. It's important to have a long-term perspective when investing in real estate. Another thing to consider is that real estate requires active management. This can be time-consuming and requires a hands-on approach. From finding and screening tenants to handling maintenance requests and dealing with unexpected repairs, being a landlord can be a demanding job. Unless you decide to hire a property manager, which of course eats into your profits. However, a good property manager can save you time and stress, making it a worthwhile investment for many. Let's talk about diversification, one of the most crucial aspects of investing, and how mutual funds and ETFs can help you achieve it effortlessly. Remember the saying, don't put all your eggs in one basket? Well, in the investment world, diversification is your basket, and mutual funds and ETFs are like having a variety of colourful eggs to fill it up. So what are mutual funds and ETFs? They're both investment vehicles that pool money from multiple investors to invest in a diversified portfolio of assets, such as stocks, bonds, or real estate. Think of them as pre-built investment portfolios managed by professional fund managers. Now, here's where they differ. Mutual funds are actively managed, meaning a fund manager makes decisions about what to buy and sell within the fund, aiming to outperform the market. ETFs, on the other hand, are typically passively managed, meaning they track a specific market index, such as the S&P 500. One of the major advantages of both mutual funds and ETFs is instant diversification. With a single investment, you can access a basket of assets, spreading your risk across various companies, industries, and even countries. This is especially beneficial for investors who are just starting out and don't have a lot of capital to build a diversified portfolio from scratch. Another perk is professional management, especially for mutual funds. You've got a team of experts researching, analysing, and making investment decisions on your behalf. It's like having a personal financial advisor, but at a fraction of the cost. This makes mutual funds and ETFs not only a smart choice, but also a convenient one for those looking to grow their wealth without the hassle of managing investments on their own. Over time, these investment vehicles can help you achieve your financial goals, whether it's saving for retirement, buying a home, or funding your child's education. By leveraging the power of diversification and professional management, mutual funds and ETFs can pave the way to financial freedom and security. That wraps up our deep dive into expert investment strategies. I hope you found this video valuable and feel empowered to make informed decisions about your financial future. Remember, the key to successful investing is to start early, stay consistent, and never stop learning. If you enjoyed this video and found it helpful, please give it a thumbs up and subscribe to my channel for more financial tips and insights. Don't forget to hit that notification bell so you never miss an upload. And I'd love to hear from you. Share your thoughts, questions, and experiences in the comments section below. Until next time, stay curious, invest wisely, and keep building that financial freedom.